going to sound odd, but I think in many cases, a lot of companies buy too much insurance. If I'm going to spend $200,000 and have somebody review all my subcontractors, but if I have a claim, it's going to cost me $10 million. Yeah, that's a pretty good trade-off for me. I'm a finance guy. I'm not a traditional insurance person. So I started my career in public accounting, spent 10 years doing that. That's where we need to get creative in how we structure.
Hello, my name is Jason Reichl, and you're listening to Risk Management Brick by Brick. I'm fascinated with people who are helping build and maintain the physical world around us. On each episode of this podcast, we'll dive in with a risk manager, speak to them about how technology plays a role in this process.
Another episode of Brick by Brick. Welcome to our special Riskworld coverage. I have Pete Kranz with me today. Pete, you were on a panel. You are kind of all over the place. You've been in the industry a while. You've been doing a lot. So why don't you give the audience at home listening a little background?
A really good way to say it. So my background, I come at it from a little different perspective in that I'm a finance guy. I'm not a traditional insurance person. So I started my career in public accounting, spent 10 years doing that. I'm a CPA. I probably can't say certified pain in the ass, can I?
Yeah.
You can edit that out. Yeah. CPA. And I was fortunate in that to deal with audits, tax stuff, financial projections, business valuations, all kinds of stuff. And it led me into that consulting area.
Yep.
I then made a move into another brokerage firm for captive management consulting. So if you know captive management, they're a big insurance tool. And I started off doing day-to-day captive management, worked my way up. I was there for 17 and a half years. The last 4 of it, formally, I led that practice. And I kind of got to this point because a lot of people would come to me and say, oh, I need to set up a captive that's going to solve all my problems.
Yeah. And
I'm like, let's take a step back and see what the most efficient way to do this is. And some of this gets into the session that we had, right? So I had exposure to doing insurance-linked security transactions, parametric programs, integrated aggregates, all kinds of stuff. And captives are a key part of that, but they're not necessarily always the best solution to it. So it's a combination of things. So I had kind of gotten to the point where I'm like, okay, I'm ready for my next role. I moved over to Alliant in 2022 to more broadly focus on risk finance.
Yeah.
And it blends everything that I learned from the captive and insurance world as a whole with my financial background in consulting and allows me to hopefully be a valuable resource for clients.
Well, I'm very glad to have you on the podcast because one of the things that I think gets overlooked quite frequently when we talk about risk profile and things is the financial risks that you open up yourself to, how your contracts are written, all these elements. Captive, do you go start a captive? Do you become part of a captive? This whole thing. So I'm excited to talk about this. So one thing from your session that I thought was interesting is this idea of controlling your risk finance destiny.
Yeah.
What the hell does that mean?
It means, like, I'm going to kind of go back first and say the way people used to look at insurance, right?
Yeah.
Buy your deductible, buy your limit. That's what it is, year over year.
Yeah.
It is what it is. Yeah. It is what it is. It has evolved into thinking about risk more holistically.
Right.
A key part of that, when you take more risk, is you want to be able, this is where a captive insurance company can come into play. You want to have a mechanism or a tool in which you can accrue your savings. By doing that, it puts you in a position where you can rely less on the traditional insurance marketplace and rely more on yourself. That's controlling your destiny, your future. It's not a short-term play. It's a long-term play.
Right. Question from kind of like when I talk to people about this is, how do you strike the right balance between, or how do you advise clients between retention and transfer? Because that, when we start talking about destiny, you start putting that off onto other people with risk transfer. You start to take some of it on yourself. So what's the balance? How do you?
So forgive me, and your audience is going to get bored. This is where I geek out.
Okay, good.
Right?
Let's geek out.
Because what I do, or what we do is, so let's theoretically say I have a $25,000 deductible and I buy $20 million of the limits on something.
Right.
And I'm spending $5 million. So I'm going to say, well, I'm taking way too small of a deductible, right? That's way too small. Attritional losses are going to carrier layer. I don't want that because it's an inefficient transaction.
Yeah.
I give them $100, they give you 80 back.
Yeah.
Doesn't make sense. So what we do is we look and we say, okay, actuarially, to the extent we can, whether it's their data or looking at industry data or whatever, is projecting out and saying, okay, what are your expected losses on a year? And then it's going a step further and saying, okay, and again, this is where I geek out. What's your 80th confidence level, right? Your 80th confidence level from an actuarial standpoint is your 1 in 5 year event.
Right.
Your 90th, your 1 in 10.
I'm about to have a real conversation about
Yeah. And that's where you can look and say, okay, my expected is this. I need to move the carrier away from that.
Yeah.
And so I need to retain that piece so I'm not dollar trading. And then it's based on a structure. If I take a greater retention, how much premium am I pulling out of the marketplace and holding now?
Right.
And then it's saying, okay, if I'm going to save $1 million a year, but my 80th confidence level tells me I'm going to have 10 million more in losses, that doesn't work.
Right.
10 million, 5 million, I lose $5 million. So we look at it and say, okay, how can I make that work, that savings work on a 5, 10, 20, 100-year basis?
Right.
And that's what starts to inform how much you retain versus where you transfer.
Amazing.
I wouldn't say amazing. This is insurance we're talking about.
No, it is cool. But what about the fact that the market is changing so rapidly? So what is the 80th percentile is a moving target? Because when you talk about actuary and all this stuff, one of the things that I'm interested in is how is insurance going to change when what was in the past may not be able to be how you make decisions, how you balance stuff. You need a more real-time model. So I'm interested in how this changes as markets change.
I'm going to say this in that these aren't the only two factors as far as the market's moving. But I'll say when you think about the risk transfer, what we're thinking about the market's moving is premiums increasing or premiums moving.
Right.
When we think about other factors in the market, it could be nuclear verdicts, right? Other things that are driving claims costs up.
Right.
So there's different
kind of like the inflation of the claims in itself.
Inflationary claim values. Yeah. So a claim that used to cost $100,000 now on average costs $250.
Yeah. Right.
Right. So there's those different factors. And on the premiums increasing, that's why we're looking at a lot of this. And that's not necessarily changing. That part of the equation doesn't change.
Yeah.
If we're thinking about claims increasing, it factors in so much as what we're retaining. But I think it all plays into the need and greater need for risk control and risk mitigation.
My big question here is, so you do some risk transfer, but now you might be putting risk off on people because of these claims going up that they can't even get that insurance anyway. So you're trying to transfer to someone who is not a reliable transfer in the first place.
That's where we need to get creative in how we structure.
Okay.
Right. So it depends on markets, right? So we have all our traditional markets, then we have our reinsurance markets and, so our reinsurance and alternative markets, and it's who we can do different structures with. So use your example. I'm going to take a $5 million primary.
Yeah.
Right. I'm going to save my money, but I still want to offload some of that. Yeah. So let's say I retain in that layer a $5 million aggregate retention, and then I lay off 10 million to a market.
Yeah.
Okay. Claims are increasing, not necessarily out of that layer, but frequency.
Yeah.
Okay. I got to push that market out to 10 million, right? The alternative markets are still there and they usually see the opportunity. Most everything is driven by the dollar amount. And I'm not trying to say everybody's greedy in that, but you have to do the equation. Yeah. And if you're that reinsurance market, it's going to affect the prices. There are always new markets coming into.
Yeah.
And we're always looking at and creating new structures.
Yeah.
So it's you could look and say, okay, the traditional structure is, I'm going to take this, I'm going to buy an aggregate. Okay. Now what I'm going to do is I'm going to take this layer, and maybe I need to keep my first event with an aggregate and lay off my second event, right? So it's kind of tweaking those programs to make it so that, yes, I'm taking risk. Yes, I'm comfortable with the risk I'm taking. The savings make sense to me, but I'm still working with that marketplace.
Absolutely. Yes, absolutely. What are some of the leadership lessons that you've learned by working at these different organizations?
Don't think about things selfishly. So from the client perspective, don't think about trying to drive revenue and sell stuff. Because when you do that, you kind of go down the wrong path. And if you try to do things the right way, try to give the best advice, then all the other stuff's going to follow. Another, probably more important, is recognizing talent. You went to our session. You saw Elena Wagner.
Yeah.
Brilliant woman.
Yeah.
Brilliant woman. She needs to be more in front of the industry, in my opinion. She's a lot younger than I am in a good way. Just I'm an old forward. But she needs to be out there, and we need to support people and support developing people, and not just having it be all about us.
let's talk about that. So what's the difference between, or what if you're advising a client, not just, out there looking for a broker, how can you tell the difference between a broker and a strategic partner who's your broker? What value-added services do they need to have, or what kind of client engagement would you expect, or would you tell people to look for?
Yeah, I don't think it's as easy as just saying this or that. You have to listen, and it's what they bring to you, right? So if that broker comes in, it's, they're listening to your solutions, or listening to your issues, your challenges, and who do they bring into the conversation? And then are they bringing somebody in that is talking about one thing, or are they listening to you, to the client, to the insured, about what are their challenges? What are the things that they're trying to deal with? And then, having a communication back and forth. And obviously they understand a lot of types of structures and can see how one might fit and one may not.
And this is a question I like to ask, because 50% of our audience would say, I love my broker, and 50% would say, who's my broker? Like, and it's all different company sizes, right? And
that's one of the things that I see throughout my industry. Why do people change? Why do they move brokers? Why do they move, when I was in the captive space, why do they move captive managers? It's because they're not getting innovation. Right. They're not getting strategy. And not that they, if I ask for it, they bring somebody forward. It's why aren't they proactively delivering it?
Yeah, that's that program balance we're talking about, right?
Yeah.
As a broker, you should be bringing that program balance to them and say, hey, here's what you're doing. This is a new strategy for us to catch.
I'll tell you, in the alternative space, 20% of the time we're successful in placing something.
Yeah.
Right? And that swag percentage, I'm just making it up. But my point is, we still need to bring forward the ideas and explain that this is the situation to put it here. Here's reasons why it doesn't work.
Yeah.
Right? Here's what we look at.
It might make sense this next year, but it doesn't make sense in 10 years.
Exactly. Looking down the road and saying it might make sense, or here's why it does make sense, or here are the options available. Here's what we might recommend. But if you're more conservative, or you're more willing to take risk, maybe it's this one.
Yeah. Here's a question from the audience about captives. So how should risk managers think differently about captives or alternative risk structures in today's environment?
The thought should not be about, I need a captive. It should be, okay, what am I doing today? And partnering, or having the right partners to go through and say, how should I be overall looking at my risk financing? A captive can definitely be, I come from the world of captives, huge proponent of captives, but guess what? It doesn't necessarily solve every problem. So it should be thinking about it more holistically and saying, how can the captive tool come into play? And what are the other things that I can put around it?
Thinking about joining a captive, how could you tell if it's a well-managed captive that you should join? That's some of the questions you would ask.
Yeah, and that's a group captive in particular, right? I'd want to know who the members are. How are they with respect to, or what industry are they? Because you could have some heterogeneous, or you could have some homogeneous. How do they fit in? The big thing is, what risk control and risk mitigation measures are put in place or are compelled by insureds. That's a huge one, because you get this group in, one bad apple can ruin it for everybody. So you need to make sure that there is quality risk control, risk mitigation, and it's a common belief, a common philosophy that everybody shares.
Trying to find the right partners to have that, say, risk, let's call it appetite.
Yeah, risk appetite and belief in controlling risk.
Yeah, great. What's one blind spot you see most often when companies review their total cost of risk?
One blind spot. It's going to sound odd, but I think in many cases, a lot of companies buy too much insurance. Okay, right? So when we think about property, right? I've got a $3 billion SOV. I need $3 billion a limit. No, you probably don't.
Yeah.
Like when you model it out, you look at where your properties are located, you probably don't need that much. And so I think it's a bit of an overspend or an inefficiency.
Do you think that a lot of these organizations on the risk side are not doing enough financial risk then? Because that would be where you would find that information. Like, come on, if something happens here, this is what it's going to cost us. Like, we don't need the whole thing insured. Like, is that just not a conversation because the CFO and the risk manager are not tied enough together? Like, where is the friction? Why is that not part of the conversation?
So again, it's not one area, it's a bunch of things. And I'll say, like you mentioned, the CFO.
When you support the clips, okay?
That's right. But when you think about the CFO, right? So typically, CFOs haven't necessarily been engaged. Now, what happened when we hit the hard market, we saw every premium, every industry going up. CFOs, they started paying attention because it's a bigger and bigger number. And so then you think about, okay, you want to introduce some of these strategic things where, I'm going to save some dollars, but I could have a loss. And guess what? That adverse thing could happen in year one. The risk manager wants the CFO involved to support them because the CFO is going to, risk manager is going to understand it, but the CFO is going to be like, okay, I'm going to endorse you strategically taking risk. Right?
So you think that's one of the most important relationships is risk manager to CFO?
I think it's one of the most important. I mean, general counsel, everybody, if you're doing, depending on what you're doing, everybody has to be involved, right? And I'll get into a little bit of minutia, but I need GC involved, general counsel involved, because I need to know if I've got compliance requirements that I need to meet.
Yeah.
Right. So contractually, do I need to have certain limits? Do I need to have whatever? Yeah.
Do you feel like a good risk manager has a risk program and a contractual risk compliance? Because sometimes what we find is contracts are sometimes weaker than what the risk managers want from a risk profile perspective.
Yeah, and there's two sides to that, right? There's the contracts that require other people to have insurance, or there's the contracts that require me to have insurance. Right. I think some of the strongest are where contracts always go through risk management review.
Yeah, right.
So that you can get consistent requirements.
Let's ask this. I think I know where you're going to. Skipping the actual review. This is risky or too risky. You ready? Okay. Skipping the actual review and trusting your gut from an actuarial perspective. So skipping the actuarial review.
Too risky.
Okay, too risky.
No.
What about when you are selecting a partner, say subcontractor, third-party risk, so you're going to transfer it to them? What validation do you think risk managers should be doing on your partner's finances?
You should definitely do a financial review. You should
basic stuff, or do you right now in this market we should be doing? Let's talk. Most of our listeners are in construction or manufacturing.
Yeah.
So
there are service providers out there who will do deep dives on subcontracts, in the construction industry.
Yeah.
They'll do deep dives. I would suggest engaging something like that, but it depends on the organization. Right? If I'm a contractor and I'm looking at subs, I might be the fly by the seat of my pants contractor and say, yeah, I'm good with it. I'm going to go by instinct.
Yeah.
I would be more on the lines of being conservative, because when you think about the dollar spend, and again, it's a very similar thing to when we're talking about how much risk to take on the insurance side.
Right. If
I'm going to spend $200,000 and have somebody review all my subcontractors, but if I have a claim, it's going to cost me $10 million.
Yeah,
that's a pretty good trade-off for me.
I love that. Letting your renewal ride with last year's limits and no benchmarking. Risky or too risky?
Oh, too risky. Yeah, you should always check. Now, you're not going to get a deep dive analytics every single year, because there's a lot of work that goes behind that for us, right? But if you have last year's done, your exposure hasn't changed that much this year, we could still use those analytics and make some informed decisions, but it should be looked at. It shouldn't just be ignored and say just for now.
Follow-up question on that, because I'm wondering so we have organizations, let's say they're a roofing company, right? And the way that they're growing now, because they've saturated their market, or their market isn't growing the way it needs to, is they go and acquire other roofing companies and incorporate them into this overarching kind of thing. How much risk does it, I don't see people doing a lot of risk on, we just acquired this company. What's their way that they manage risk, the way that they brought their vendors in? You think you can just go and buy a mom and pop roofing company and then indoctrinate all their vendors onto
not for a construction company, but for other acquisitions.
Yeah.
I've had that conversation 10 times in the last 2 months.
Yeah.
And it's, as we're looking at a strategy, they're looking and saying, oh, we could acquire this entity. It's 5% of what we're currently doing.
Right.
Okay. Fine. We can just roll it in.
They're looking at
30%, 40%, double the size.
Yeah.
Yeah. We gotta, if we're looking at this alternative stuff, we gotta kind of pause, incorporate, get a handle on what's going on, and then we move forward.
So I think that's,
or
growth,
or keep
yourselves up to a lot of risk that we're not even be aware of.
Agreed. And the other option would be renew separately. Bring your entity in, keep your insurance programs the same, just so we can start to get some of that alternative benefit.
Yeah.
Or the benefit of alternative structure. And buy your insurance, do your thing over here.
Yeah.
So
I don't think that the premiums you're going to get by combining it all into one is going to be worth the risk.
Exactly. Because I've had that conversation so many times, just over the past couple of months.
Here's a question. Building your entire risk program off broker templates, risky or too risky?
Too risky.
I don't know if you're allowed to say that.
Yeah, no, but I'm not. I fit in this weird little space, and that I'm a finance person, and I don't want any template. Templates are okay, but you have to apply some level of judgment, look at stuff.
Yeah, great. A piece of advice you would give someone entering into the insurance industry in any role or capacity, what do you think it takes to be successful in this industry?
So a piece of advice is kind of two different things there. Piece of advice I would say is, as you're entering in, set up meetings to talk to people, to understand what's going on. Personal example, I had a friend of mine's niece was in mathematics, was looking for career opportunities, still in college, was a year out from college, came to me. We talked about accounting, captives, and gave her some ideas, and she liked what we did. Ultimately hired her when she graduated. One of the best hires I've ever had.
Yeah, I love that. I find that our industry is, you get into it very interesting. Yeah, I've been in tech. I'm a tech entrepreneur.
Yeah.
Before I was in this world, I felt like I was making technology to make, I don't know, some sales software better. Yeah, I'm not going to say who I work for, but you can imagine that. Whereas now I'm helping the built world, because the insurance is a real thing that people need in order to take risks to build the world around us. Yeah, that's why it's brick by brick.
Yeah.
I feel much better about myself and what I do because of that. And I find that when people come into the industry, they're surprised by how open it is, how everyone is kind of willing to help each other, even if they're competitors.
Agreed.
And that having a world that's more secure is better for business.
Yep.
Forever.
Yeah.
So,
and I'll be honest, I think what you're doing here, granted, I'm talking about, I don't know what all your other sessions are, but bringing forward the need or the conversation about risk financing and those ways to look at it, I think is a huge thing.
Yeah.
And it does a huge service to the industry.
Thank you, man. I really appreciate having you.
Yeah. Appreciate it.
Yeah.
Risk Management Brick by Brick is brought to you by TrustLayer. Find out how TrustLayer manages risk so that the people can build the physical world around us. Head over to trustlayer.io, and then make sure to subscribe to Risk Management Brick by Brick on Apple Podcasts, Spotify, or wherever you get your podcasts. On behalf of the TrustLayer team, thank you for listening.